Good morning, ladies and gentlemen. Well, we've had the long-awaited Powell speech at Jackson Hole, and we really didn't learn very much. What we have learned is that he is quite happy with the higher level of long-term rates as they do some of the tightening job for him, and he's quite happy with tight financial conditions for a while. I don't think the market is going to move very much at all over the course of the next couple of weeks unless we get some very new inputs from non-farm payroll or from the possibility of CPI being higher than projected, in which case we will get more tightening. But otherwise, I think the Fed is on hold now for a protracted period of time. Some people will argue that Powell's speech was not as hawkish as could have been expected. Some others will argue that he was definitely hawkish. I would argue that he was realistic. He basically is saying that he doesn't know where R star short term is, and I don't think anybody does. And he's basically saying that they are going to err on the side of caution, whatever the data shows in the very short term, and that therefore the market has to discount the fact that they are going to stay higher for longer and possibly not move for a very long time. Now, are the odds of a hike in September going to move to more than 50%? That is entirely data dependent, and it's entirely dependent on NFP and CPI. CPI comes out on the 13th of September and NFP comes out on Friday. So, to me, that means that the SOFR curve has to actually discount the possibility that we are going to be stuck at this rate or a slightly higher rate, and I don't think that that really matters for an awful long time. What needs to be priced out are the very steep cuts that the market has priced in for next year and possibly the year after. So if you have a look at what the market response was, perfectly logical and exactly what I expected. They took out 10 basis points in 2024 and then less out there in 2025 and 2026, but they still closed negative. To me, the 2024s now are going to be in a bit of a wedge on the downside. We can actually enlarge this part of the chart. And basically, I think we are going to be wedging down towards another 10, 15 basis points, but not much more than that. So it's the volatility of the moves that is going to come down more or just as much as the market is going to come down from 95.25 another few basis points. I think our option strikes are almost perfect unless and until we get some new data. I really don't think that this market is going to rally at any stage, and I really don't think it's going to make or sustainable new lows for very long. It might go down 5, 10, 15 basis points, but that's about it. I think the volatility of the 2024s and the 2025s is going to fall considerably, but still with downward pressure until data shows otherwise. And the bond curve reacted in much the same manner as the SOFRs. So basically they priced in a new high for the twos as the possibility of the cuts gets priced out in 2024. That pressures the very short end of the bond curve, the twos. How high are they going to go? According to my maths, unless we start going to more than 60 or 70% probability of hikes, and that's not going to happen until we get a very, very hot NFP number. I think, another 5, 6 basis points is all you can look to the upside, and that is consistent with the Bollinger Bands, and then we're just going to trade in a range between 5% and 5.15. That is basically the low end of the new volatility range. Because if the Fed is going to be on hold for a very, very long time, is there really any reason to start taking twos up to 527? I think that's not going to happen until and unless you get new data which shows that that is the way it should go. But if you have a look at what happened, twos went up 5 basis points, threes 3.5, fives 2, and the 10-year was completely unchanged. What I liked about the all the interviews that I saw with the governors was that two of them specifically mentioned that they like this new higher level of long-term rates because it does the job for them. It basically tightens financial conditions without them having to hike. So to me, the 10's around 4.25 for the time being is normal. I really think that the ranges are going to get smaller and smaller until the data shows which way the next move is going to go. And that is unlikely to be NFP because we're expecting a low number, and we already know that, there isn't a single piece of data which is showing that unemployment is turning over right now. And therefore, I think the volatility is going to be tightened and compressed for the rest of this week. And I don't think even NFP moves it because we know what it is. We know that it's going to be in line or possibly a little bit stronger than what we are expecting. So to me, the 10's are going to trade in a range between, say, 413 and back to the highs around 434. That is going to be your range for next week unless we get some new piece of data, and I don't think we will. Is the yield curve going to steepen or flatten? Well, it did flatten just as we expected, and for the reasons we expected, which is I've just given to you. How high can 2's 10's go? Well, not very much higher. I would have thought 89, 90 is going to be a decent level to wait for NFP or see before NFP. And I think the odds are then that it reverts back down to 75. But I think the movements are going to be very, very limited. If I'm looking for very limited movements in the outrights, I can't really be looking for very much in the yield curve. If we analyze what is coming out next week, we have 2's, 5's, and 7's, about 125 yards of it, and that is Monday and Tuesday. So the pressure is going to stay on the very short end, the 2's, 5's, and 7's. Basically, people will be selling 2's and 5's. IEF can't do much better, 2's can't do much better, 5's can't do much better, and therefore the yield curve, if anything, over Monday and Tuesday is going to have a tendency to go towards 90, but then it probably stops and waits for NFP. Not an awful level to short it at 90 basis points. If we have a look at what 5's 30's have been doing, that gives you the same idea. If we can see something like here around the 22 area, probably not a bad place to place some shorts and look for downside. But I think it's all going to be limited, and it's all going to be within a 10-15 basis point range. So what I'm saying is that you have to be even more precise with your levels and even more patient, because I don't think the moves are going to be big. And if you have a look at what Move did, it did exactly the right thing. It came off. Options are getting sold because the market reckons that the moves from now on are going to be limited. Let's go back to a chart of the tens and really start analyzing what is likely to happen over the course of the next, say, 2 or 3 weeks. Unless NFP and especially CPI are way out of line, what do we know? We know that we have a Fed that is now arguing whether they are at terminal or within 25 basis points of terminal. I don't think the 10-year note gives a damn about that. What they care about is A, how high real yields need to go, how high the term premium needs to go, and how long the Fed is going to be on hold for. Well, the term premium is nearly back to zero. It's very, very difficult to see very much more impulsive moves in the tens to the upside. Very difficult indeed, because real rates are quite high, and the data that we're going to get is very unlikely to be way out of line of what we expect. And therefore the Fed is probably going to be on hold or have one more hike. And that is as far out as we can see. So if we see the 10-year note up towards the 4.5 level, I think it's a great level to buy some call spreads, because I think at some stage it's going to trade back down towards 4. So my 1 month to 2 month range for the 10-year is between 4 and 4.50, and basically trading there as opposed to trending. I think we are not going to have any kind of a trend in the bonds for quite some time, unless we get something really outrageous in terms of data. And I think that volatility has to come down some more, and I think the outside of these ranges need to be sold. No way are we going to have a bull market in futures, i.e. a trend down in the 10-year note, because I don't think A, the data is going to warrant it, and B, there is so much issuance around that is very unlikely. The risk reward is to basically sell futures on any dip towards anywhere near 4% and really buy some speculative call spreads when it gets to around the 450 area. I really don't think that we're going to see very much for the remainder of the foreseeable future, i.e. at least a month. Christine Lagarde's speech at Jackson Hole was actually far less bullish than I thought she might say. I mean, she was actually quite bearish, and I didn't really expect that. I thought she'd at least give a nod to the weakness of the European economy, and she didn't. So really German rates seem to be stuck as well. This is the tens, the Bund, and really, you know, we had the nice little candle here on the data in Germany, and then we've really done nothing. I think this is really going to be very, very boring for another few weeks, just like the US. The one I'm looking at very closely is the bobble. I think it's very, very clear that if we start breaking 245, we have got a top. And really, I much prefer longs in Europe than in the US. The reason is very simple: far less issuance, right? Far less issuance, and an economy which is far weaker than the economy in the US. So this keeps on making sense. I don't think any move is imminent because whatever you look at, the twos, the fives, the tens, they're all bouncing from support and really just trading in a very tight range. There's absolutely nothing that gives you any kind of a trend indicator at the moment, not even the yield curve. If you look at twos, fives, it's coming back. I think any kind of stuff like here around 54, you're looking to sell it. And I just don't see anything which is telling me that we should be aggressively doing anything in the bond market, but trading very precise ranges. There is nothing here, whatever spread I look at, whichever part of the yield curve I look at, that tells me that we are embarking on a new trend. I think it's going to take a long time, and I think that the 24s are going to keep on bleeding, as I showed you earlier, by a few basis points here and there, as people just price out the very aggressive cuts. And that is an environment which, on top of supply, is not conducive to any huge rally, but basically a trading range. And I think, everything I look at points to a trading range with the highs of the trading range probably not in the US, but most probably in for the whole of Europe. So now let's have a look at the differentials and see where we can trade those. Here we have the fives, and I think the fives are beginning to be more interesting than the tens. I think any kind of a move back to 174 is a buy for 208, very much longer term. And here is the tens. Basically, they keep on failing at this 173 level. So they might give up a little bit and come back down towards that 162 level. But given that I'm looking for such little movement in the US, I really am not really looking for any great big movement in the bunds either. So I think the ranges are going to get smaller and the opportunities for trading are going to get, smaller and smaller. I just don't see anything in the tens that is likely to be actionable next week. I certainly think that if we see this 162 level, we should try buying it. And in the fives, I think that if we see 174, which is unlikely, I think, we also need to buy it for a longer term move towards 208. But these are very long term things, and I think the likelihood is that just like here, we piss around in a 5-10 basis point range and never touch the 175 buy level, and certainly probably don't take out 192, 193. It's going to be very quiet, and I think people are going to be disappointed by the lack of volatility on NFP as well. Well, given what I think about interest rates, I now am thinking that the dollar's run is probably coming towards an end for quite some time. I think this 104.50, 60, 70, maybe around 105 is about as much as we can expect until NFP gives us more ideas. And as I told you, I don't think it will give us very many. So basically the range is going to be tight. I think dips are going to get bought towards 103.50, 60. And 104.50, 70, something like that is going to be about as much as you can expect. We're sitting right on top of the Euro USD 200-day moving average, but I think, 109.30 is probably as high as you will see it. And, stopping a few people out is going to be, the order of the day. But I don't think we go any lower than 107, 106.80, something like that, and then bounce back. Basically, that is all I can see happening in the dollar. I don't think we're going to have violent moves next week. And not even on NFP. I think the triangulation between what the dollar is doing and what the bond markets in Germany and the US is doing all point to lower volatility for a while. Gold is basically trading in parallel with bonds. It's not deviating a million miles from what the long end of the bonds is doing. If you look at UB, it had slightly better week because, the pressure is on the short end, and therefore gold went slightly higher, basically a relief bounce. Do I think that the 30-year is going to rally? Not more than a few basis points. Therefore, I don't think that gold rallies very much indeed. If you see this 109.70, 80 area, I think that is about as high as gold goes. The dollar's not going to do much, bonds aren't going to do much, gold isn't going to do much. It's basically as simple as that. I still see absolutely nothing to do in DBC. It's sitting at unchanged for the year and basically doing nothing. Very tight ranges again. I still think that if we see a dip in DBC gold, or rather gold DBC, that will mean that gold will be a buy again. I just don't think that this is sustainable. Anything down to 703, you should be looking to replace DBC with gold, i.e. add to your gold holdings and get rid of some commodities. Basically, it's all trading around unchanged, and that makes sense. If the bond market is not going to have any big moves, how's it going to drive these other markets to have big moves? I think the volatility is going to get suppressed in everything over the course of the next couple of weeks. I thought over government, basically the totality of the stock market, over the totality of the bond market tells its own story. This is a daily chart, 1, 2, 3, 4, 5 days. Where did it go? Absolutely nowhere. So, the long end of the bonds quite like the fact that he's going to remain tighter for longer and therefore had a little bit of a relief rally, 3, 4 basis points. I mean, pathetic, right? And, the equities went nowhere, but slightly better with it. What did they close? 0.5% better on the week. So it's a continuation of this story. Until we get some data which shows that the economy is rolling over, I just don't see how this can go very much down. Can it come down and fill a couple of gaps? Yes, sure it can, but it's not going to go very far. So I can't see any volatility in equities because I can't see any volatility in bonds. I think this ratio isn't going to move very much until we can see that either growth is reaccelerating, or I don't know what, or that the Fed needs to do much more. I just can't see that happening at the moment, simply because we've anticipated what Powell was going to say. We did the right adjustments in the market. What is there left to do apart from wait for the developments that the data is going to give us? I can't see very much upside to the equity markets, and I can't see very much downside to the equity markets, as for the same reasons that I can't see a lot happening in bonds either. I think the two are tied at the hip. but that equities over time should perform better than bonds is for sure, because all the issuance is in the bond market. It's not in the equity market. So I really don't see that we're going to move very much outside of these ranges, however much people might be expecting a recession at any moment. I don't think we're going to get a recession, or the market is not going to see a recession for some time. Can it come? Of course it can, but it's not going to happen next week. And therefore, I don't think that this ratio is going to be very much changed by the end of next week. From everything I've said so far, it basically means that when trading, we need to be very, very precise in our levels. So if we enlarge here what's happened, to me, this 44.60 level is going to be absolutely key. And I think that that's the only level that you can look to do some put spreads or buy some puts or sell outright. And we are terribly, terribly unlikely to take out the lows, simply because you have the 200-day moving or 200 period moving average underneath it as well. So the downside, I think, is going to be decently protected. And any foray down here, you're going to get bounces that come to at least 43.95. So the only level that I would look to short would be this 44.60. And equities, again, they are being pressured by these ridiculous multiples that they're trading at. But I think that for them to start going down and taking out these multiple, i.e. a multiple contraction, it's going to need data. And I don't think that, next week, even though it's chock full of data, is going to provide the push that we need for that to happen. I just think that nothing is going to happen until CPI, and that is what, the 13th of September. So I think we have 2 weeks of going up, down, sideways, and then we decide. For direction in the US, I keep on looking at the Dow, and it keeps on disappointing me. I'm looking for any kind of a close above this 34,601, which would tell me that there is a little bit of impulsion that we can go back to these levels, for example, of just above 35,000. But it keeps on disappointing me. And if the Dow stocks can't get going to the upside, eventually they will drag down everything else. But it's a question of patience. I think great patience is going to be needed. And whichever chart you look at, of whatever period, say from 195 minutes to daily, you're getting contracting Bollinger Bands, which basically means that for a while it's going to be range bound, and not to expect too much, and to basically contract your trading ranges and to look for lower volatility of lower realized volatility in any case of what the market is going to do next week. And I think that's probably going to be the name of the game next week. More precision, less volatility, less realized volatility. And I think that Friday and NFP is unlikely to change that, simply because, as I told you, we're looking for a low number anyway in the sort of mid 100s, and we are unlikely to be disappointed on that expectation, and therefore I really can't see very much at all happening. Even stocks, which should be one of the weakest stock markets, right, because that's where growth is threatening to go into recession, and Lagarde was slightly hawkish, is not showing any signs that it's going to do very much at all. We have the 200-day moving average giving support just below where we closed on Friday. And we have some weekly charts which basically are showing contraction again in terms of Bollinger Bands. Again, this is something that tells me that you have to be very precise at the level that you trade, and that really I'm not a seller until 43.66 in the in the stocks. I really think that, yes, can we come back up to 4300 and 4330? Yes, but I think 43.66 is going to be very, very difficult to see. So really, what I'm saying is that I don't see that we are going to be able to do very much in this market. If we enlarge it, we can see that really these kind of levels, 43.60, is where one should be looking to sell it, and that's exactly where the moving averages are turning over. I don't see any fundamental reason to really sell it here. It should be the weakest market, but really, the trade would probably be to sell it against puts in the S&Ps when this market does a rally. So say you see 43.30, you can sell stocks and sell puts on the S&Ps, at the money puts on the S&Ps, thinking that the stocks are going to retrace down more than the S&Ps, and then you might be looking to make some money that way, because this should be the weakest market. But even that one is not showing a lot of signs of life to the downside. Does the vol chart allow for slightly lower realized? Well, this is implied, but does it allow for realized to lead implied down? Yes, it's right in the middle of the Bollinger Bands. Everything is contracting here as well. So we have every market contracting Bollinger Bands, whether it's bonds or whether it's the equities, and now even volatility. I think the likelihood is that we come down a couple of percent or 1% or something like that, and basically put biasing this 1450, which allows for that modest upside in equities that I showed you earlier, and not much more. So precision and expectation of low ranges, I think, is the theme of the week. I hope I've suitably brought down your expectations for what next week can bring. I'm sure that there will be something happening, but nothing that I can see that is going to be important from a macro point of view or that is going to last. But we shall wait on events. I think that we could be looking for levels to look for steepeners again in 2s10s and 5s30s. If we see those, that's probably what we should do. Otherwise, I think we just sell put spreads in the equities when they come down. That is likely to be a winning trade for next week. Short-term put spreads, I think they go to zero. And that's about it. Thank you very much indeed, and tweet you on Monday.